Hello and welcome to Morning Markets. I'm Roger Peterson. Thank you very much for joining us. Here are some of the stories we're tracking for you in the BNN Bloomberg newsroom. Canadian energy company Emera reporting weaker than expected fourth quarter results, with adjusted profit coming in below analyst forecasts. The results were weighed down by its Nova Scotia Power and New Mexico gas operations, as well as underperformance in its Florida utility unit. Emera's Canadian electric utilities also saw a sharp drop in profit compared with last year. On the upside, the company beat expectations on revenue. Shares of Arcelix are surging. Gilead Sciences is buying the biotech firm in a deal valued at about $7.8 billion US. Gilead will pay $115 per share in cash, plus a potential additional payment tied to future sales. The acquisition strengthens its oncology pipeline, adding a promising cell therapy for multiple myeloma. Gilead has been looking to diversify beyond its core antiviral medicines. Shares of Domino's Pizza are edging higher today, up about 2.8 right now. The pizza company reporting fourth quarter revenue of $1.5 billion US, beating analyst estimates and rising more than 6% from a year ago. U.S. same-store sales also rose, with franchise locations outperforming company-owned stores. Domino's also posted stronger store expansions. And looking at the markets right now, the TSX being dragged down by the tech side. It's up about 4.7 right now as a whole. South of the border, similar situation. A lot of red over there as well. All this tariff uncertainty fueling it. Tech concerns as well. You can see the S&P 500 off by more than a point. Dow by almost 1.5. And the NASDAQ by 1.2. Loblaw says it will spend $2.4 billion in 2026 to build 70 stores, renovate nearly 200 others, and expand its supply chain capabilities. The plan includes new No Frills, Maxi, and Shoppers Drug Mart locations. Joining us to discuss this, Sylvain Charlebois, professor and researcher of food distribution and policy at Dalhousie University. Professor, thanks as always for joining us.
Good morning, Roger.
First off, is this a kind of normal expansion plan, or is this a little bit accelerated this year?
Actually, pretty much every year we hear from Loblaw announcing that they are spending $2 billion or more supporting their fleet of stores. So it's actually quite normal. They do announce typically the number of stores they'll be opening, the number of conversions, and of course, every now and then you'll see more than 100 stores being renovated. What's unusual this year compared to past years that we are seeing a grocer adapting to a much more frugal market. So we are expecting more discount stores. Metro actually made the same announcement a couple of weeks ago in Quebec with Super C. So you can see that really Canadians are struggling at the grocery stores, and grocers are adapting. So we're not dealing with an overstored market in Canada. There's still plenty of space for growth, but things are getting tighter, especially when it comes to discretionary revenues, or the money that people have to spend at the grocery store.
And I'm just looking at one of the numbers out there also, but they're expecting revenue estimates for Loblaws to be outpacing key industry data. Does that seem like an unusual mix, or is that them just putting things together perfectly?
What they're trying to do is optimize the supply chains. So what was announced this morning is that they're planning to have more of Shoppers Drug Mart stores right next to their own stores, grocery stores, to basically build synergies, supply chain synergies between outlets, which is interesting. Of course, anyone who's been to a Shoppers will have noticed that slowly we're seeing these stores or these pharmacies becoming more like mini marts. And so they've been quite successful in deploying that strategy over the last, I'd say, decade or so. And that's going to continue over the next several years. And probably that's where the growth will come from for Loblaw.
Why not merge them then? Why not just put the Shoppers in the same footprint?
That's a very good question, Roger, because I mean, you go to Walmart and the pharmacy's right there. But I think they just want to keep things separate for now. I wouldn't be surprised if they're thinking about it, but for now, they absolutely want to keep both brands, both stores separate for now. But physically, you can see that they're trying to bring them closer and closer to the other banners.
And with the shoppers, are they approaching saturation for them? I mean, it feels like everywhere you look, you see a Shoppers.
Yeah, I thought there was some saturation, but they're still building and there's still space for growth. And of course, with urbanization, people are moving around, people are spreading, and cities are growing. Some cities are growing. So absolutely, I think right now you're seeing grocers adapting. Pharmacies are in demand. People are getting older, and pharmacies tend not to sell only food, but they sell medical drugs, and they sell cosmetics as well. So those are things that older populations tend to want as well. So there's still a lot of room for growth for sure.
Now, is there any concern with the slowing population? We even had the negative population growth. Is that having an impact on their plans?
Absolutely. Well, when you're in business of filling stomachs, that's certainly a number that you're looking at. Canada has failed to attract new players into the market. The challenge is that we have grocers that are really managing the Canadian market quite well. Margins are pretty decent, but they are playing defense quite well. So we're not expecting a new entrance anytime soon in Canada. However, we are expecting some of our grocers to open up new stores as our population stagnates or slowly grows.
And then going back, as you mentioned, about it's no frills that are going in. Is this the first time you've seen where is it all no frills and lower end supermarkets that are being opened?
Yeah, Maxi in Quebec and no frills outside of Quebec. There are some conversions expected with superstores into no frills or Maxi as well. So again, I think grocers really are fully aware that that Canadians are having a hard time with food prices, and they're just basically readapting, changing their portfolio of stores to adapt to a much more frugal consumer out there.
Will that mean lower prices, do you think, for consumers?
More stable prices. Yeah. Wishful thinking there, Roger, I'm
well,
sure.
A man can dream, Sylvain. A man can dream.
It's tough. I mean, right now, the food inflation rate is at 7.3%, the highest among G7 countries. But we are expecting the food inflation rate to drop, but it doesn't mean that we'll see lower food prices.
Not even with them going with the more no frills opening up.
No. Well, with some verticals, we are expecting lower prices, but generally speaking, we are expecting some section of the grocery store to be more expensive, like animal proteins, the meat counter, dairy, bakery is moving up right now. But the center of the store, that center of the store is under tremendous pressure. So coffee, which has been very expensive, we are expecting prices to drop over the next several months.
All right, I'll drink to coffee getting cheaper.
There you go.
Can the independents compete with the big boys right now?
I think what we're seeing right now are small independents. I've seen stories, Roger, around the country of small independents making a difference. It is possible to open up a new chain. There's one chain in Quebec called Liquidation Marie. They now have 12 stores. Another chain that actually was in the news of late, they have now 8 stores. So if you actually can cater to a niche market, whether it's for an extra frugal market or consumers that are looking for premium products, I think there's still room for these players to actually make a difference in Canada.
Okay, Professor, always a pleasure talking to you. Thank you very much for joining us.
All right, take care.
Sylvain Charlebois is a professor and researcher of food distribution and policy at Dalhousie University. Up next, with Trump's tariffs struck down, analysts are sizing up the fallout and what CUSMA's protections really mean for Canada. More on that when we come back. Analysts are still assessing the impact of Friday's decision by the U.S. Supreme Court to strike down the bulk of President Donald Trump's tariffs. The CUSMA agreement allows extra protections against tariffs, but what does it mean for Canada? CTV's Jeremy Sharon reports.
Less than 24 hours after blasting the Supreme Court for striking down some of his tariffs.
Deeply disappointing.
Then immediately imposing new ones. U.S. President Donald Trump today already announcing in a social media post his Section 122 global tariffs are increasing, raising the 10% worldwide tariff to the fully and legally tested 15% level.
I was actually quite surprised the president didn't come out with 15% across the board yesterday as the very first measure.
The new duties imposed under the U.S. Trade Act are limited to a maximum of 15% and would require congressional approval to extend beyond 150 days.
Many thought that the Supreme Court ruling would actually see the president back away, but that has not happened. And so I think what we're seeing here is now Congress is going to be left to its own devices to try to rein in this president.
According to the White House, the tariffs won't be applied to goods covered under CUSMA, meaning they'll have little direct impact for now on the Canadian economy.
For Canada, we're in a temporarily somewhat lucky position of having those extra protections afforded to us by CUSMA.
But with a mandatory CUSMA review deadline set for July 1st and an administration that has indicated it will spend the next months investigating trading partners' policies, threatening further tariffs through different legal means, this former senior advisor to Prime Minister Justin Trudeau, who was involved in the last round of trade talks, suggests challenges lie ahead.
So with all these deadlines up against each other, Canada may find itself in a very precarious spot come summer.
Section 301 of the Trade Act of 1974 is what Trump is relying on for new tariffs when the current ones expire. It allows the president to use new levies if they deem trading partners' policies are unreasonable and discriminatory. Trump has repeatedly called Canada's supply management system an unfair trade barrier. Jeremy Sherrill, CTV News, Ottawa.
And for more on where we stand in the wake of the U.S. tariffs, this decision on it, we were joined earlier by Gavin Graham, CIO and Portfolio Manager at Spire Wealth Management.
More confusion. It's another day in Trump land with tariffs being applied and then raised literally 24 hours later. However, as the report was saying, Canada and Mexico are to a certain extent sheltered from this because the vast majority of our trade's going through under CUSMA, Canada, US, Mexico Trade Act, which of course Mr. Trump passed himself in his first term. That expires at the end of June, so obviously there is a time limit on this. But at the same time, the tariffs that Mr. Trump is imposing at the moment expire after 150 days, unless they're approved by Congress. So in essence, we've got to get things sorted within the next 4 months or so. Otherwise, it's likely that there will be some increase on tariffs generally on Canadian exports, as it is certain industries like, for example, steel and aluminum, lumber are already facing higher specific tariffs because they're considered to be strategic industries. And so those industries in particular have been having more issues. But in general, for Canada, I think the number is less than a 4% tariff on the vast majority of goods, thanks to CUSMA. And obviously that just reinforces the importance of trying to get some sort of deal struck with the US before CUSMA expires come July 1st.
And what's the reaction been like in Europe?
Well, it's generally, I think it's more of the same in that, for example, the UK, which had a 10% tariff, which was more attractive than that applied to the EU, which was 15%, now finds it's paying 15% as well. So that's a specific effect on one economy. But in general, it's more of the same. And I think there's a recognition that there is going to be continued uncertainty over tariffs and trade under this administration, at least until the midterm elections, when there may be some change in Congress's willingness to go along with this. Although, having said that, half a dozen Republican congressmen did actually vote to avoid applying tariffs to Canadian exports, along with the Democrats. So it looks as though there may be some cracks starting to appear in the coalition that's allowed Mr. Trump to apply the tariffs generally. But I think the most important thing is that the US Constitution is actually seen to be working in that a 6-3 majority of the Supreme Court, a number of whom were actually appointed by Mr. Trump himself, has ruled that it's Congress that has the right to actually impose tariffs. It is a trade effect, which is specifically assigned under the Constitution to Congress, and that while the president may use executive orders, as he's done again, it's not actually down to him, down to the president to be able to actually set trade policy. It has to be done in cooperation with Congress.
I know. I feel that that's kind of been lost a little bit. The idea that this the conservative-dominated court went against him, and rather not overwhelming, but it was 6-3, which is a fairly good, solid majority, and it's that seems to have been lost because so many people we've heard talk about, the U.S. is lost and we're devolving into fascism and all that. But I think that shows the system is working.
It certainly does. And again, the Congress, my apologies, the justices of the Supreme Court are appointed for life. And very often presidents have appointed people whom they thought would agree with most of their policies and opinions. But once you have a job for life and cannot be replaced, then you may decide to choose to actually apply the law as you see it. And in fact, one of the major opinions on the ruling was that this is a specific right specified in the original Constitution, that Congress has the ability to set tariffs. And therefore, as you said, some of the sort of conservative justices, some of whom were appointed by Mr. Trump, have chosen to actually look closely at the wording of the Constitution and say tariffs are a matter for Congress. And therefore, as you say, it's encouraging to see that the system as designed by the founders is actually working quite well.
That was Gavin Graham, CIO and Portfolio Manager at Spire Wealth Management. Coming up, we'll get an update on the situation in Puerto Vallarta following the death of a cartel leader that triggered violent blockades, flight cancellations, travel warnings, and shelter-in-place orders across the state. Violence erupted Sunday in a popular vacation spot for Canadians, Puerto Vallarta, elsewhere across Mexico as well. A military operation against the Jalisco New Generation cartel killed its boss, known as El Mencho, decapitating the country's most powerful drug cartel. Now, we spoke to CTV's Scott Hurst for the latest on the situation.
Lots of concern about how it's impacting residents and tourists alike, as Puerto Vallarta is one of the more popular destinations in Mexico for Canadian tourists, not just during popular school holidays like we just had the Family Day weekend. And of course, there is March break coming up in a couple weeks. But many Canadians go down there for an extended period of time to get away from our winters and enjoy the sunshine and beaches in Mexico. But right now, they are caught in a significant amount of violence as this popular Mexican beach destination is on edge. The violence triggered by this military operation that you mentioned against one of Mexico's fastest growing criminal networks, the Jalisco New Generation cartel. Mexican forces killing its leader, the man known as El Mencho, during a shootout as the military attempted to capture him. Cartel members then responded viciously and violently, creating a chain reaction with even more violence sweeping across the state of Jalisco to block military operations. We did hear from Mexican President Claudia Sheinbaum this morning, who said all the roadblocks have been cleared and is trying to urge calm, saying authorities are doing their best to ensure that residents and tourists alike are kept safe throughout this military operation and the retaliation, Andrew, from the cartel members.
Lots of travelers, though, stranded right now, including many Canadians. What's the advice for Canadians?
The advice for Canadians and other travelers alike is to shelter in place. And the advice coming from the Global Affairs Canada is to keep a low profile, limit your movements, and listen to local authorities about the possibility of trying to move about the city, about the region, and potentially trying to get to the the airport. Global Affairs has updated its travel advice to Mexico to exercise a high degree of caution with added regional advisories that include Jalisco and Puerto Vallarta because of the security situation and the outbreak of violence. It is difficult for Canadians to get out, to get home, because Air Canada, WestJet, Canadian Airlines have canceled all flights to and from Puerto Vallarta as this violence has erupted, trying to work with customers on other options. But of course, the security situation takes precedent because it is so pressing and so volatile right now, and the fears that it could continue. Foreign Affairs Minister Anita Anand says the Canadian government is watching the situation closely. We're expecting to hear from her later this morning in the 10 o'clock hour. So hopefully at that point we can get more information on what this means for Canadians, the advice for Canadians, and the attempt for so many of them to leave Mexico and get back here safely, so that they're not caught up in this ongoing violence between the Mexican government and cartels.
And that was CTV's Scott Hurst. Coming up, Domino's Pizza topping fourth quarter revenue estimates as U.S. sales remained resilient. We'll take a closer look right after the break. Loblaw shares are moving higher after the corporation said it will invest $2.4 billion in Canada this year. It's up about 2% right now. The plan includes new Shoppers Drug Mart pharmacies and discount grocery banners such as No Frills. The company is also continuing construction of a large automated distribution center in Ontario. Loblaw says the spending will create 9,000 jobs and is part of a broader 5-year investment plan. The European Union says it will suspend the ratification process of its trade deal with the U.S. and is seeking clarity from the White House on its new tariff program. The move comes after the Supreme Court blocked parts of President Trump's trade agenda. Trump has since said he will raise global tariffs to 15%. Meanwhile, the European Commission says the U.S. needs to honor its tariff deal with the EU, adding that sudden, unpredictable levies disrupt markets and supply chains. Merck is reorganizing its pharmaceutical business, creating a separate division focused on cancer drugs as it prepares for sale pressure later this decade. Its blockbuster immunotherapy drug is set to lose its U.S. patent protection in 2028. Merck says the move will help it sharpen its focus and support more than 20 upcoming drug launches as it works to offset the expected decline in revenue for the popular drug. Looking at the markets, rough start to the week. Everywhere you look, the TSX tech sell-off there hurting it. It's off by 0.41%, but still well above 33,000. South of the border, the tariff concerns having an impact down there. You can see the S&P 500 off by 0.96, almost a full point. Dow Jones 1.4, and the NASDAQ more than a point. Domino's Pizza delivered a fourth quarter revenue beat with stronger than expected domestic comparable sales and solid store expansion. Joining us now to break it down is Peter Saleh, Managing Director and Analyst at BTIG. Thank you very much for joining us, Peter.
Thanks for having me on.
Any standouts from this fourth quarter?
Yeah, for sure. 3.7 U.S. comp, driven almost all by traffic growth. It's head and shoulders above its pizza competitors, head and shoulders above the QSR industry. They are hitting their mark, hitting their targets on what they said they were going to do. They said they would deliver 3% comps in the U.S. in 2025. Nobody believed them, and they did. And now they're guiding for another 3% comp number in 2026. And I think based on the stock reaction, I don't think anybody still believes them. So they're delivering on their targets, and we think the stock is way undervalued here.
What are they doing right?
Well, look, I think this is a function of they're growing their carryout business, which was up, call it mid to high single digit same store sales this year. that's a category that's 20% larger in general than delivery, and so they're growing in carryout significantly. They also have some of the best value in the industry with the $6.99 mix and match, the $7.99 carryout. You're seeing some of the other promotions that they're launching, Boost Weeks and Best Deal Ever. So they have a lot of deep value on the menu, which is really helping them to take share and has been for call it 10, 15 years now.
Now, we've seen other fast food restaurants lower prices to try and get people in. Are they going to be following that?
They don't need to lower prices because they're already the value leader. So I just don't think they're going to be taking a lot of price as it is. They didn't take price in the most recent quarter. I think they'll take very little amount of price going forward. But when you're getting a $7.99 large pizza that's a carry-out special, I don't think you're going to find a better value for that product anywhere else. So I don't think they need to lower price, but then again, I don't think they'll be taking a lot of prices higher.
And are those prices, that's what keeping it? I'm just looking, no weakness among younger, lower income consumers like others we're seeing. These people are still coming in, eh?
Yeah, I mean, order counts are up, so the customer is rewarding them with more transactions, and they're not losing customers at that lower income or the younger consumer like we're hearing from others. They're also not really seeing an impact, at least not yet, from the GLP-1 effect. So in our view, they're really executing extraordinarily well, and they continue to take market share. We think that market share gain continues into 2026. Keep in mind, their largest national competitors are all closing stores, refranchising stores, and shrinking, whereas they're adding stores and growing.
They really are going against the grain, aren't they?
Yes, they are, and we expect that to continue. And also keep in mind that despite all these great numbers that they're putting up, 8% operating income growth, 3% same-store sales growth, and great guidance going forward, this stock is trading at or below a 10-year trough valuation. So in our view, very much undervalued.
Why do you think that is?
I think investors are focused a little bit too much on some recent credit card data, which suggests it should be weaker. It suggests that it should have been weaker in the fourth quarter. It was not. Suggests it should be weaker in the first quarter. We don't think that's going to be the case. So I just don't think the investors truly believe the story. We're not sure what else it's going to take to turn the tide here, but there's also a lot of concern around GLP-1, which I think is a headwind to the industry by maybe 100 basis points this year. But I think they can overcome it given all the market share opportunities that they have.
And any other potential headwinds?
No, I see more tailwinds, really. Look, I think if we get more stimulus, lower taxes for that lower and middle income consumer, that could be a little bit more of a tailwind for them. World Cup could be a tailwind for them, especially in international markets. They have a lot of international stores. In the U.S., they don't think the World Cup will be much of a tailwind, maybe a very modest. So maybe there could be a little bit something there, but don't see a lot of headwinds here. I do think that, the 3% number is very achievable in 2026.
And any concerns about the slower international comp performance?
No, it is a hair weaker, but they continue to perform pretty well. I do think next year, with the benefit of the World Cup, you'll have a little bit of an acceleration there from what we saw in the fourth quarter.
All right. Overall, it just sounds like everything's clicking along. Anybody challenging them right now? Anybody even close?
Not really. I think they're taking share from just about everybody, including the larger chains and some of the independents as well. We do think, McDonald's is resurgence here, but it doesn't seem to be impacting their performance so far.
Okay, Peter, we'll wrap it up there, but thank you very much for joining us.
Great. Thanks for having me.
Peter Saleh is the managing director and analyst at BTIG. Coming up, Canadian banks report earnings this week. We'll have a preview on what to expect after this. All Canadian banks report their earnings this week, starting tomorrow with Scotiabank. For more on what to expect, we were joined earlier by Matthew Lee, analyst at Canaccord Genuity.
The setup is favorable right now. If you think about the different factors that go into what makes bank earnings work, we have strong capital markets, strong wealth. We have credit that's remained relatively benign. Loan growth's not there yet, but overall, yeah, I mean, absolutely looking for a good year.
I guess the worry is always about possible consumer losses. What is your feeling? I mean, we are seeing some weakness in the Canadian job market, but you don't think provisions are going to be a huge problem?
No, I mean, I think you've probably heard this term before. It's a K-shaped economy, right? Mm-hmm. And for better or for worse, the banks are most levered to kind of the higher end of the consumer range. What that basically means is that until unemployment really starts to ramp up, or if it does, there's some protection there, especially on the mortgage book. Where we might see some pain is the credit card book. I think even in Q1, you could start seeing some impact there. But overall, again, credit's been benign. Most of the banks have guided towards downward sloping in the second half of the year. And I think 2027 might actually be even better.
Talk to us about Bank of Montreal. You say they have a pretty high return on equity. However, work is needed on their U.S. operations?
Yeah, their ROE is the lowest of the group, but it is improving. And so one of the biggest incremental data points that we got from the quarter so far is that they expect to be exiting 2027 with an ROE of 15%. Now, their ROE in 2025 was 11%. So if you do the math there, I mean, that just generates great earnings growth. And they can do it from a number of directions. U.S. banking, to your point, Andrew, that's a big piece of it, right? They're going to have to do a lot better in the U.S. in terms of generating wealth management revenue, reducing costs, rationalizing the footprint. But, Canadian costs, Canadian credit, those are going to be factors as well as the fee revenue we talked about earlier, investment banking, wealth management.
So you have a buy on Bank of Montreal. You also have a buy on Bank of Nova Scotia. You feel that the repair job or the restructuring at that company is doing well. They had quite a few years of underperformance.
Yeah, they've done a good job, but they've had great execution over the last couple of quarters. If I look at the international business in particular, I mean, that was something that a lot of folks didn't want to touch last year. It was an area of major concern. I think right now people are turning around on LATAM. Maybe it's going to be a growth area. Probably not in Q1 right away, but over the next couple of years, that could be an outperforming earnings grower.
CIBC, you have a hold. Is that because of valuation?
Yeah, primarily. I mean, look, they've been executing great too. They've done a good job rationalizing costs, growing net interest margins. I like the way that they've been performing, but their valuation, they're not cheap anymore.
Why have investors been jumping in to CIBC?
To CIBC?
Yeah.
Yeah, I mean, you know what? Everyone likes a good execution story, right? If you're doing well and you're blocking and tackling correctly, in this business, investors reward you, and they should. They've earned every dollar that they've kind of improved. Their ROE's been great. Their Canadian banking operation has been very successful. To me, the biggest question for CIBC is where's the next leg of growth, right? They don't do international. They don't do the U.S. So it's a lot of Canadian exposure. For the valuation at this juncture, it's just not there for me.
And National Bank, also you have a hold. Do you feel the stock is relatively expensive?
With National, it's kind of the same story. Again, yeah, to your point, it is expensive. I think when I think about what I like in a bank right now, it's stories where the earnings growth is relatively easy in terms of, how you're going to get up, 10 or 12% over the next couple of years. So nothing against National. I think they've done a very good job, but a lot of their earnings in 2025 came from capital markets. To me, there is some questions around the replicability of that versus BMO, like I said earlier, where the steps are clear in terms of how you're going to get earnings growth.
Royal Bank, the aircraft carrier of the sector, you do have a buy on that one.
I mean, you can't bet against Royal, right? I mean, their ROE is great. Their ROE guidance is even better. And frankly, I think that they can outperform that this year. If I look at the kind of recipe that they've got, their wealth management business is the biggest. Their U.S. exposure is good. Their capital markets is best in class. I mean, it is expensive. Royal is not a discount bank by any means, but when you buy that, you're buying quality, you're buying execution, and I think they've done both.
What is your, okay, and we'll just round it out then, TD Bank set to go on winning back investors?
Yeah, I mean, you know what? It's been an incredible story over the last couple of years. We obviously had the anti-money laundering issue with TD. They came out of that. They apologized profusely. They invested in order to make sure their AML strategy was succinct and strong. You know, they've restructured the U.S. business a lot. I think there's a lot of growth there. I mean, in Canada, TD banks 1 in 3 Canadians in some form. I mean, you know, you can't beat that market share. In the U.S., they're a top 10 bank as well. And frankly, it sounds like the strategy is in the right direction right now. I think that's what people like.
1 in 3 Canadians, you said TD does business with one way or another?
Yeah.
That's amazing. Just finally, Matthew, I don't think you cover EQB, but could you give me your broad thoughts on them becoming a bigger competitor with the acquisition of PC Financial?
You know, I don't cover it. I do believe that there's always a benefit to having a bigger, more scale bank. So, you know, anything that helps you do that profitably is good. Again, I don't cover it, though, so I don't really have a qualified opinion on that one.
For sure. The government, as you know, in the latest budget made noises about increasing competition in Canadian banking, but my guess is anything will occur at a glacial pace.
Yeah, I mean, look, the Canadian banking system is very strong. We've done a very good job of managing through crises. We've protected the Canadian consumer. We've protected savings. Even, you know, given the real estate market today, we're not panicking the way that they did in the U.S., you know, over a decade ago. So I think you have to balance adding competition with, you know, providing those protections to Canada overall. And I think the banks have done a really good job. You know, and the other thing to say about that, too, the banks are competitive amongst each other, right? I mean, you talk to any mortgage broker, you talk to any retail banker, any commercial banker, they're out there competing every single day. So I don't think there's necessarily a lack of competition in Canada.
And he was speaking with Matthew Lee, an analyst at Canaccord Genuity. So with earnings season about to kick off for Canadian banks, we'll hear from the CEO of the Bank of Montreal after the break. BMO Capital Markets is hosting its 34th annual Metals and Mining Conference this week in Florida for a look at the mining sector as well as bigger picture issues such as tariffs and the Canadian economy. Our partners at Bloomberg Television spoke with Darryl White, CEO of the Bank of Montreal, live from the conference.
It's very important when I step back and think about what we're hosting here this week. It really is the greatest metals and mining show on earth. We've got in the neighborhood of 7,600 one-on-one encounters that we're coordinating and hosting. We've got 350 capital providers, which is the most we've ever had in our 35 years doing this. And we've got over 600 corporates who are here as well, taking part in a really important conversation, I think, in this moment in time, in particular, when we think about the global forces that are colliding into the critical mineral space. This is a very important conversation at a very important time for the economy and for the future of the next 5 or 10 years of our resilience agendas.
Darryl, we'll get into exactly what the demand could look like, which metals are going to be priority, what the production plans are going to look like. I am curious how much people there are talking about tariffs this morning, given the IEEPA ruling by the Supreme Court, the fact that metals might be among some of the most affected.
Yeah, you know, Lisa, I think it's early days. I mean, the announcement's a couple of days old on IEEPA. If you look at the market reaction, it's been pretty subdued, as we've all been talking about this morning. I think part of that is because some of the outcome that we saw over the last few days was probably priced into bond markets, so we haven't seen much of a reaction there. And if you talk to most of the corporates that we're dealing with, the reality is over the course of the last year or so, the instability and the volatility that's been brought by various decisions over the course of the last year on tariffs have become a little bit more normal course. So in the meantime, they've rebuilt supply chains or organized themselves in different ways to have resiliency and how they think about dealing to surprise or maybe not such a surprise as the case may be, depending on the audience. So in the meantime, more stable than you might think.
How much do you hear also a discussion around domestic production and expediting some of the licensing around getting, say, for example, the copper mine in Arizona up and running at a time when there is this priority on metals of all sorts?
Yeah, that's a live conversation. I mean, I think it's a very important one, because if you think about the confluence of two forces, we've got the demand being driven by the AI power up. So the newest industries are literally dependent on the oldest industries. In addition to the global order reorganizing at the same time, there's a massive demand push here. And the response to that at the end of the day is going to hit a bottleneck on the supply side. So the needed reorganization of permitting, of getting to market faster, of regulatory reform is a really active conversation. And I think, as you know, we're seeing some positive developments on that, particularly here in the United States.
Are companies feeling confident right now, though, to pour money into the United States in this sector?
I think companies are feeling confident, and perhaps more importantly, we've got investors who are feeling confident and trying to pick their spots. And when we look at the North American continent, it's particularly attractive. There are other places in the world that are attractive as well, but they may come with a higher risk premium.
Do you see consolidation in this space? I know there was potentially going to be a Glencore deal that fell through, but do you see potentially that this space right now, given everything you've described, is ripe for more consolidation?
Yeah, there is a lot of talk of consolidation. We've seen a fair bit of consolidation over the last 6 to 12 months, haven't we? And right now, if I look at our own internal pipelines, they're as full as they've ever been. Our teams have been responsible for advising on 70% of all M&A activity that we've seen in the sector globally in the last 4 years. We expect that to continue as we go through this year, and the conditions, both from a capital perspective as well as the efficiency perspective of the producers, are pretty constructive for that consolidation theme as well.
This is a space that the Trump administration has taken aim on to take actual equity stakes. Has that been positive, or is that concerning to the individuals you're talking to, because potentially it means less competition?
Yeah, but I would say on balance, it's a very good question, but it's generally been positive because it feeds into the narrative of needing more reliable, bankable solutions on particular demand signals. So we've got a demand signal, we can set a floor. Capital craves certainty, as we know, and certainty isn't a luxury. Certainty is something that folks need in the sector to make those investments. So on balance, well-structured, these are considered fairly positive interventions. And we're seeing other countries around the world slowly follow step and look at projects like these as well.
Daryl, there is a lot of controversy, certainly in Montreal. I was just actually in Montreal just not a long time ago, and I was overhearing people saying that they're trying to avoid going to the United States. And you could definitely feel a certain sentiment there. Has it made it difficult for you, being both in Canada as well as having increased your U.S. platform, to navigate the growing tensions between the two countries?
Yeah, look, we've been doing business for 208 years, and 207 of them we've been in the United States. So this is a long game for us, and it'll be a very long game for us. We're committed. We continue to be committed to both countries, almost in equal measure. They're very important client bases for us, and we continue to run our strategy as we always have.
How much do companies on a cross-border level have difficulty making decisions about deal-making, about investments, when you do see such an uncertain landscape that will affect the long term potentially, right? I mean, you think about the USMCA that could get renegotiated. I mean, how much is that affecting some of the discussions that you hear on the ground there?
Yeah, it is affecting the discussions for sure. I think what you've seen is we're now about a year into the volatility that we've seen around uncertainty of tariffs, all kinds of tariffs. But over that period of time, corporates move pretty quickly. They're able to reorganize their supply chains, make decisions based on the path of most certainty, not least certainty. And you do see some reorganization going on there. And our bankers here have been there to support them through all of those discussions.
Building on Lisa's point and putting hockey aside, we have seen a more acrimonious tone coming from Washington to this government when it comes to Prime Minister Mark Carney. I would just love your reaction from his speech at Davos, which didn't name the United States, but there was that tone that he was calling out the U.S., forcing allies to pick between China and U.S.
Yeah, look, I think in the end, if you look at the economic cooperation between the two countries over a long period of time, we have no anticipation that that's going to change. In the meantime, if you look at some of the middle powers of the world, Canada included, are there things that we can do for our own agendas, that we can consider what's going on right now as a bit of a wake-up call, whether in the country of Canada, it's interprovincial trade barriers, it's productivity and efficiency of our own, are diversifying our trade relationships at the same time as we preserve a wonderful relationship with the United States for the long term. Those are all good things.
You also in the past talked about how Carney should be cutting taxes. You don't think that Canada is competitive on tax. Do you like what you're seeing out of the Carney government?
I do, and I will also underscore that it remains early days. The government has been in power for a little less than a year now with a full mandate. There have been some changes that are positive. There are more changes along the lines of competition, along the lines of competitiveness, along the lines of competitive tax that always should be considered through any government, but I think we've seen material progress over the last year.
That's BMO Chief Executive Darrell White speaking with our partners at Bloomberg Television. Market Call is coming up next. Today on the show, we have Jerome Haas. He is the portfolio manager at Lightwater Partners. He'll be taking your questions on Canadian mid-cap stocks. Let's take a quick look at the market, see how they're doing. Bay Street is up first. After that record close on Friday, it is off today. It's been slowly inching its way back up, but it's still off by about 0.38%. Taking the biggest hit, tech sector right now is off, but going the other way, the materials index, and there are some winners today. Let's take look at a couple of them. First up, or three of them actually. B2 Gold is the one we want to pull up right now, and they are up 6.6% right now. This on the news, they've appointed Mike Cinnamon as the chief executive officer to succeed Clive Johnson, who's retiring. He has been the CEO since the company was founded in 2007. B2 Gold is up by 6.65%. And Lundin also moving today, up 5.5%. That on the news. The company announced a $670 million silver stream for equity deal with Lunar Royalties, a move that lets it tap into strong silver prices amid the global uncertainty and the market volatility. It's responding up 5.5%. And one last quick one, we won't get too far into it. Loblaw announcing new store openings and renos, and it's up about 2%. South of the border, everybody is in the red. And that is it for morning markets. We're out of time. We'll see you tomorrow. Have a great day.